Welcome back to the channel, guys. This is the next installment of the Coinbase IncomeShares breakdown of the £1,000 investment, and it's going to be the update for June. Most of you have asked me to continue covering this series. I'm continuing to do that. For those of you that aren't familiar, I put in £1,000 into the IncomeShares Coinbase ETP from August 2025, and this is the update for June. The initial capital was 1,000 shares, and it bought me on 5th of August 2025, 333 shares. It's currently worth £290 at the time of recording. There might be a slight lag when this actually goes out, which was around 87.3p per share. That's an erosion of 70.9% in capital. However, I have had total cash dividends of £409.52. That's a cumulative yield of 41%. And then the total wealth is £700. I'm down around about 30%. Now, I want to reiterate, I'm not reinvesting any of the dividends. The whole point of this experiment is to see what will happen if we were to never reinvest, take all the cash, what would happen to our payments, and also could we ultimately beat the underlying, which is the important question that a lot of people want to know the answer to. Let's look at the total return versus the artificial yield that we're seeing. One of the things I commented on the fact is obviously on the websites, the yield that we see on the site isn't necessarily the yield that we are now getting based on our position. And we can see that yield fluctuated quite a bit month to month. And actually at the current time for June, it's actually up slightly. It's recovered at 36.9%. The higher the yield on cost, the better for us. Obviously, what in the distribution yield is what the current yield is according to IncomeShares website. Where did my £1,000 go? Here we're going to break out all of the income. We're going to break out the total return against the net, and we're also going to manage that against Coinbase. So what we can actually see here is that the pure coin value, if I just held coin, same amount of value, £1,000 in coin, would be worth £613. There is still some erosion there. If we look at the remaining share value, it's of the COII, so the IncomeShares Fund, it's £290 roughly. Cash distributions is around £409. The capital loss is around £300. But what's interesting is that the difference versus holding pure coin, I'm actually up 8.7%. We can actually see the advantage of the fact that coin has had a bit of a sideways movement, and we can see that on the chart visually here. We can see we're actually performing better, and a sideways is actually a really positive thing for these income funds. We can see here that we are actually outperforming the underlying. What's actually interesting, what you'll see is that the gap has remained around 30%. If you look at the capital loss, it's held at around the 30% mark for quite a few months now, probably going back all the way till around about February of this year. January, I think, was a little bit higher than that, yeah. But yes, it's held around the 30% mark. Now, this is just to show how the wealth is distributed and then the cumulative cash that I've seen and the monthly dividends. We can see how, due to the fact that coin is very volatile, we can see those up and down swings quite a lot with the amount of monthly dividends we get. It started off at around 38 and we're at 30 today, but we can see how it went up in October, went up in November. Then we had quite a dip in December, January, started to recover a bit in February, and then dropped again in March, dropped again in April, went up in May, and has gone up in June again. But I want to dig into three kind of effects of the decomposition. What I want to really do is start to drive what's affecting the fund. And it's the share price is a combination of the dividend, the coin, and the puts. And I want to recognize that in terms of how it's impacting the paper money that I own in the stock. What I've also overlaid is coin's volatility as well. Now, what you need to recognize is the first mechanic is the dividend. And that's a mechanical expectation in the sense that we receive the income and it comes out of the NAV because ultimately it has to, that's how they mechanically function. And we expect that. That's what we're expecting to get our distributions from the NAV. And that's a mechanical process. I'm not really counting that because that's just transfer of capital from the fund to me. It's not traditional erosion of any kind. We then have the 25% sleeve, and this is how much we own in coin, which is approximately 25%. Sometimes we go up a little bit higher, go a little bit lower, depending on the value of coin and the market price. But what I wanted to overlay here is month by month, how we can see the value of coin going up and down because of coin price, right? Because of the underlying. And we can see how in some months we are slightly up, but in most months we're actually down like 6% in November, and that had quite a big impact. What we've also got is the put. What happens with the puts is obviously we're writing a lot of puts and they also have an impact on the fund, and they have a realized and unrealized loss associated to them. And that also impacts the value of the NAV as well, because if we are owing or having to buy the coin because we're in the money based on the strategy, then we have to buy the shares or buy the contract out. And I'll talk a little bit later around that. And then the real final impact is the friction. These are things like the fees that what we pay, that 0.55% fee, and plus any other fees that the fund needs to pay to roll, etc. I've tried to embed all of those, and we can start to see where, in fact, we only really had one good month, which was in May. The rest have all been negative, and this is why my capital ultimately has been eroding. I want to go into a bit more detail into all of these things and try and break down and explain this table in a little bit more detail, just to get rid of some of the jargon, because I recognize some of you are probably fairly new to investing. This may be the first time you've seen this video, and trying to understand some of the terminologies can be a little bit confusing. I just want to cover some of the terminologies before I get into some of the details. NAV, net asset value. What is that? That's the total value of the fund divided by the number of shares equals the share price. When the NAV drops, the share price drops by the same amount. We then have the dividend, or sometimes referred to as a distribution. And this is the cash the fund pays you, usually in this case monthly, coming from, in this case, selling options that lands into your brokerage account on payday or around payday. We then have, in the case of this strategy, a short put. And this is a cash secured put, which basically means that they have cash ready to deploy. The fund sells someone the right to sell coin to the fund at a set price, and this is known as the strike price. If coin stays above that strike, the option expires worthless and the fund keeps the premium that they've earned. If coin drops below, the fund has to buy coin at the strike price. The strike price is the pre-agreed price at which the put buyer can sell coin to the fund. It's a contract, right? I'll buy your coin at X dollar no matter what. And then the premium is the cash the fund collects up front for selling the put. This is the fund's revenue and the source of your monthly dividends. This is really important to understand where your money is ultimately coming from. We then have the ex-dividend date. This is the day the dividend is extracted from the share price. On this day, the share price drops by the dividend amount, and then the dividend then gets paid to you approximately 10 days later. Another crucial factor of options is the implied volatility, and you'll hear this terminology a lot, which is the market's expectation of how much coin, which is the underlying, will swing. The idea being a high IV market expects big moves, puts pay nice paychecks, and a low IV environment, quiet market, you get thin premiums. Now, I mentioned this M to M. What is this? Mark to market. This is the position of what it is worth right now. The fund revalues its open put positions every day based on the current coin price and IV. If the puts are now worth more, the fund's NAV drops by the amount, even if the puts have not been exercised yet. And a lot of people don't understand that's also moving the price around on a daily basis. We then have something known as the gamma. This is how risky does my position get as coin moves. High gamma, the put's value accelerates as coin moves through the strike. for the fund, which is in this case short puts. High gamma is bad, losses snowball on the way down, and gains trickle on the way up. And I'll go into some of the detail of this in a little bit later on as well. And the other element is the time decay, the theta. Every day the put exists, it loses a tiny little bit of value, all else equal. The fund benefits from the time decay because it short puts each day that passes. It's a small win for the fund's NAV. Another key metric to understand is total expense ratio. This is the annual management fee charged at a percentage of your investment. COII in this case is 0.55%, taken out the NAV daily. It's a slow bleed on the share's value, okay? And then we have realized versus unrealized profit and loss. Unrealized, which is the paper market to market gain loss that hasn't been locked in yet. The fund revalues its open puts daily, but hasn't actually closed those positions. A realized one is an actual cash gain loss when the position is closed. For short puts, the loss is only realized when the put expires in the money and the fund buys coin at the strike, or the put expires worthless and the fund keeps the premium as realized income. Until then, the M2M is just a daily estimate that could vanish if coin recovers before expiry. And then we've got the yield on cost versus the distribution yields. This is a really important metric to understand. It's one I constantly want to remind people of, which is this is the yield on cost is a monthly dividend times by 12 divided by what you originally paid. That's your average. And then the distribution yield, which is a monthly dividend times 12 divided by what the share is worth today. That distribution yield rises as the NAV falls. It's a yield trap that makes the fund look more attractive than it is. And we saw that right at the beginning when I showed this kind of metric where we can see what the website is advertising is 127% today, but my yield on cost is 36.9, considerably much lower. Okay. I want to talk a little bit around why the dividends swing around so much and the connection to the IV, the premium and the dividend chain, and also a bit of a lag concept here. The monthly dividend is not a fixed yield. It's the premium collected from selling cash secured puts during the month minus any fees. The premium per contract is a function of coin's implied volatility at the time the puts are sold. More IV, faster premium, bigger dividends. That means that the dividend you receive in month N was priced by the IV environment in month N-1, so the prior month in effect. This is why a fat dividend month is almost always a lagging indicator of a high IV period, not a coincidental one. The chain, coin volatility spike, option premium expands, puts sold at fat premium, next month's dividend jumps. And we can represent that, right? The lag worked during October and November 2025. We had a high IV environment, vol spiked to approximately 85% to 155%. The November 2025 dividend of £94 is the visible lag. Put premium was struck when IV was ballooning, dividend peaked exactly when volatility did, one cycle later. And then we can see where the lag worked against us. By February, March 2026, IV collapsed to 78 to 80% as coin bottomed between March and April 26. Dividends of £27 to around about £23 are basically the tail. The NAV kept bleeding because short puts were still marked against the elevated vol, and dividends fell while the NAV continued to decay. This was the worst possible combination we could have had. The question then becomes, is the dividend tied to NAV or is it tied to IV? The monthly dividend is tied to the IV at the time the puts are sold, not to coin's NAV. The NAV share value is tied to the marked value of the outstanding short put positions driven by current IV and current coin price. The dividend equals past IV, the put M2M equals current IV plus the gamma, and the share price is equal to the dividend plus the 25% coin sleeve plus the put, which is around 75%. Now, one thing I do want to talk about in terms of the M2M, the put numbers in the table that I'm going to show you in a second is only assuming the paper, not the reevaluation of what the open shorts would cost to close right now. They're not realized losses. The actual P&L only crystallizes when each put expires, which happens in one of two ways. The put expires worthless if coin ends greater than strike. If coin is above the put strike at expiry, the put dies worthless. The fund keeps the full original premium as realized income. The mark-to-market loss that appeared in the meantime is just evaporates back to zero, and it's never a realized loss. Path 2, the put is exercised, coin ends below or equal to strike. If coin is at or below the strike at expiry, the buyer exercises. The fund is forced to buy coin at the strike. The realized loss equals strike minus current coin price times 100 shares per contract. The previous M2M estimate becomes the actual hit, and the M2M is now realized as a real loss in the fund. Just some sort of insight, the £250 cumulative part of the put over the 10-month period is the worst case scenario. If you froze coin at today's price forever, in reality, every put expires in days or weeks, and time decay, the theta, means that the M2M of any put that ends out of the money shrinks towards zero as expiry approaches. The realized P&L is almost always better than the cumulative M2M suggests, which assumes coin doesn't crash dramatically through multiple strikes. Looking at the three effects to the coin NAV, we've got the dividend drop, which is mechanical. As we know, this is part of what the fund is designed to do. The mechanical share price drop on the ex-dividend date equal to the dividend per share. We then have the ex-dividend date itself, purely a function of the dividend amount and the share count. And then once a month on the ex date, predictably and instantaneously, it takes effect. And then it's always negative from the share price on the X date. But the positive lands in your brokerage account as cash. And over that 10-month period, that's where we saw that cumulative impact. It was 100% realized because it ended up in our bank account, and it dropped our NAV by £409.52. That's where 57.7 of our NAV decline came from. But we got the cash. That's fine. We've then got the 25% coin. This is the underlying. The mark-to-market move on the 25% of the NAV held directly in coin shares. Coin price return 1-to-1 with the 25% slice in pound terms or dollar terms. That's happening continuously every trading day in line with coin's percentage return. Direction is it tracks coin 1-to-1. Income impact, it is paper mark only. And then we have the 10-month magnitude, which is approximately 6.3% of my NAV decline. And again, this is 100% realized at this point. We can see how we've lost 440, almost 450, just over 450 pounds, just between the distributions and the coin shares. And this is predominantly because coin went down during this period, okay, itself. And then we've got the 75% short put M2M and the IV and gamma effect. The day-to-day change in the market value of the still open short positions, approximately 75% of the NAV, which is unrealized until expiry. If coin ends up above the strike, the M2M evaporates and the fund keeps the full premium as realized income. What drives it? The current IV, level and change, coin price, time decay. Gamma is the biggest single driver. Time decay works in the fund's favor. Any put that ends out the money sees the M2M shrink towards zero as expiry approaches. It's continuous, everyday trading, but not linear. Gamma is when coin moves through the strikes. It's slightly different hit when we talk about the coin sleeve and the put options. And it's asymmetric, puts gain fast on coin drops, decay slower on rallies. And the income impact is paper mark only. But we can start to see how this has actually eroded the fund down to 35.9% of the NAV. And that is a realized split that's hard to justify. And I'll talk about why that's hard to justify in a second. And then we finally have the friction. This is the ongoing drag from the 0.55% fee, the management fee, the roll cost, the bid-ask spreads, the slippage on each option cycle. And that expense ratio of 0.55 per annum plus transactional cost typically is around about 3% of the premium collected. And this bites daily. The management fees occurs continuously, rolls hit at each option expiry, and it's always negative for the share price at an expense. Okay. And if we look at the estimated, that's around £14.66 or around 2.1% of my NAV decline, plus the fees and the rolls. If we accumulate this, the share value went from £1,000 down to £290 at time of recording. Of that, £709 lost. 58% was mechanical dividend drops, almost 60%. 6% was the 25% coin slice, and 36% was the short put book, of which 2% was friction. That's the costs and the management fees, etc. The £254 put M2M is a snapshot as of June the 1st. The realized portion requires a lot more information in terms of the fund position level data to determine. And I'm going to talk about that in a second. But hopefully you can start to see where the fund is bleeding. We can bleed from the 25% of coin, which is the direct ownership, plus the put mechanisms, plus the fees. I don't account the mechanical drop from the dividend because we're receiving that and it's a transfer of capital. It's not down to the fact that we've lost money. That's actually realized in our bank accounts. I want to talk about the nuance of the M2M realized versus unrealized and what I can and can't tell you. What I can verify with the data that I have is that the £254 cumulative is a real number calculated from the share price changes, the capital values that I've got. The £45 coin drop, that we can calculate because, again, we can calculate the returns for each day for coin. I can validate that. And I can also validate the dividends because we've received that from the IncomeShares distribution data. Those are the 3 points that I'm fairly comfortable with the numbers on. But what I cannot verify is which puts are still open versus closed because I don't have that level of data. And I don't want to kind of guess some of this stuff, but you know, they do send us the strikes, but we don't know exactly when they're opened. We don't know exactly when they're closed, when they've rolled them. And so we don't know whether they're assigned, whether they were worthless. The exact percentage of that £254 that is realized versus unrealized, this is the question everyone wants the answer to, but unfortunately I can't give you that answer as part of this video, but I can recognize that percentage has led to that portion of the NAV being eroded. But what can I say with confidence in terms of the framework and not the numbers? In terms of that, the put positions, there's a couple of things they can do in the scenarios. They've got 3 scenarios. Let it expire. If coin is greater than strike expiry, the put dies worthless. And the M2M that's kind of scared last week goes, no cash changes hands. And the premium we've already received when we sold it. Option B is we buy it back in cash. If the put is in the money and the fund doesn't want to own coin, it can buy back the put at its current M2M value, and this locks in the losses as a realized cash loss. Option C is get assigned. If the put is in the money at expiry, the buyer exercises, the fund buys coin at the strike, adding to the 25% direct holding. It could be a realized loss if they try and balance the current position. Kind of takeaway is that the negative £709 NAV decline is real money in the share price sense, but the truth is not 100% viable without the position level data. However, we can confirm that our bank account, which is the £409 dividend, we can validate the movement of coin, which during that period was negative £45. And we do know the market loss is the remainder of that plus the fees. The next typical question is, can the fund stop rolling? The fund can choose not to roll the put positions. Each put has a defined expiry and the fund can simply let the book run off, but there's a trade-off. Option number 1 is keep rolling, right? Write mostly weekly puts, much higher trading frequency, more response to IV changes, Open a new short position and close existing ones as needed throughout each week, not just on a fixed monthly cycle or weekly cycle. Maintain the 25-75% allocation and rebalance back if skewed, and keep generating premiums, keep paying the monthly dividend, which is a net of all weekly activity. Obviously, the pro is the dividend continues. The con is high trading frequency, more roll costs, more assignment cycles. The monthly M2M data is just a snapshot of the weekly activity rolled up. And then option 2 is don't roll. Stop the bleeding. Let the put book run off naturally over the next few months. Don't sell any new puts. Existing puts will expire worthless or assigned. It stops the compounding risk and stabilizes the NAV, but the dividend drops to zero within a couple of months and the fund becomes a sleepy coin holding with no income, which obviously no one's buying it for. What happens at assignment and the mechanics? When a put is exercised in the money expiry, the fund is forced to buy coin at the strike. The fund sold a put with a strike of $250. It collects $500 in premium. At expiry, coin is at $200. The put is $50 in the money. The outcome is the buyer exercises, the fund buys 100 shares of coin at $250, which equals $25,000. There's a realized loss here, right? $50 times by 100, which is $5,000 minus the $500 premium they've already received. There's a net loss of $4,500 in the fund. The new holdings, 100 COII shares, are added to the 25% direct slice, and the allocation shifts. 25% coin grows because the new shares are added, but the put book shrinks because you've got one less put now in this particular simple example. But what if they choose to actually rebalance, the 25% rebalancing death spiral, as I'm going to call it? After each assignment, the fund's allocation drifts away from the 25 to 75% target. To rebalance, the fund sells new puts. The fund writes mostly weekly puts, not monthly. The cycle can repeat many times per month in a volatile market. And in a sustained falling market, this creates a compounding risk. And we've seen this with coin, right? This is exactly what we've seen. Coin drops, let's say $300 to $200. Weekly puts struck at $300 expire in the money or get closed early. Fund assigned buys coin at $300 and it's a realized loss at $100 per share. 25% coin slice now larger, more shares added. The fund writes new puts to rebalance back to 25.75. New weekly puts must be struck at lower levels, otherwise no premium income. Say the strike is at, let's say, $200. The current coin is at $200. These are at the money puts with maximum time value, but also maximum assignment risk. The premium collected is fatter. You've got high IV regime, but the puts are now riskier because they're at the money, higher chance of being assigned. If coin drops further, even by next week, the new puts go in the money, assigned again or closed early, another realized loss on the new tranche. And this kind of repeat the cycle weekly, multiple cycles per month. Each round realizes a loss, write new puts at lower strike, and face higher assignment risk. And this kind of leads to the pivot that is about to happen or potentially about to happen, which is around hedging and the retention change. And they mentioned this a couple of times. Buying protected puts would cap the downside of any further assignment cycle. Retaining premium in the NAV would build a cash buffer to absorb future assignments without forcing a rebalance. And I want to touch on this part because I think this is really important and I will cover that in a second. And by the way, guys, if you're enjoying the video so far, don't forget to hit the like button. And if you haven't already subscribed, please do. It takes me a lot of time and effort to pull this together, but I know it's really useful for you guys to understand the mechanics of these funds. Let's look at the 6 bad months and the 4 good months and what it means. Out of the 10 paid months, the put M2M split cleanly into 2 camps, and the pattern reveals exactly when IV was hurting you and when it was helping you. The 6 bad months were puts gained value, IV hurt the NAV. During September, the put M2M 75 was negative 110, October, negative 125, December 89, January 6, April 25, and June around 10. The IV stayed elevated or rose and or coin dropped, and the short book marked up as a bigger liability, draining the NAV beyond what the dividend was paying out. But we did have 4 good months where the puts decayed, IV helped. During November 25, it was positive at 55. February, it was positive at 21. March, it was positive around 11. And May, it was positive around 26. What we can see is the IV crushed or coin rallied, the short put shed value, partially offsetting the dividend drop. And May was actually the cleanest. NAV actually rose by £4.99, even after the £25 or almost £26 dividend was actually extracted from the NAV. We can see that actually when coin is going up, these funds will perform well and you will get good total returns, and the payments will also be very good. Now, I want to talk about some things forward looking now in terms of the hedging. Now, this hasn't actually officially been announced yet, so I don't know whether it's happening or when it's going to happen, but I kind of want to explain the concepts of the hedging so people can understand it for those of you that don't understand it. On March, there was an official note of the downside hedging strategies being introduced. 2nd of April, Octay, head of marketing for IncomeShares, confirmed the fund will begin retaining a portion of options premium inside NAV and not disputing 100%. Both moves address the same problem, which is a NAV bleed, but slightly different mechanics. Both will reduce the monthly dividend, but how each one works and what to expect. Buying protected puts, or long puts as they're typically referred to, creates a floor. When coin drops, the long puts gain value, offsetting the short puts loss and the net M2M near zero on a down day. Retaining premium in the NAV means the cash extracted from selling puts is no longer fully paid out and some of it stays in the fund, growing the NAV and mechanically reducing the Ex-Div drop. The result is smaller drawdowns in down markets, and the worst months could be less than 5% instead of negative 20%. But how does it hurt the dividends? Protected puts aren't free. They cost premium to buy. The cost comes out of the premium collected from selling the puts, leaving less to distribute. Also, the retained premium is literally the dividend you no longer receive. It's kept in the fund to build the NAV. This can result in smaller monthly payments, and the current approximate £90 per month could drop to around £15 to £50 a month, depending on how much they hedge and the intensity of that hedge. And I kind of want to talk about the three different scenarios of how this hedging could impact. If we were to look at the same £1,000 holding under the three different coin price paths, we've got an assumption here that it assumes 75% short put book, 50% retention, 50% hedge ratio, and a mid-range IV of around 80%. Again, these are just scenarios. This is just for illustration purposes only. Currently, the monthly dividend, in assuming that coin drops 15%, the monthly dividend paid is around 60. In the current, in the new world, it would be 30, half. The premium kept in the NAV would be another 30, and the 25% coin slice would not change. And the puts, this is where the protection comes in. Before it would be negative 120, now it will be negative 40. And then there'll be a cost associated to that hedge, which is negative 15. The net share price change in the current environment will be negative 97. In the new environment, it'll be negative 62. And the cash flow would be plus 60 versus plus 30. And the total wealth change would be slightly better. Is it much better? No, but it is better. Instead of negative 37, it'd be negative 32. And that's with a drop of 15%. Let's say there's the moment of coin moving sideways. This is where the dividend paid would be 55 in the current, the new would be 28. The premium kept in the NAV would be again 28. The coin slice, coin's not moving around, it's sideways. We'll just say there's no change. The puts, in this case, because we have the protection, it's actually going to be positive plus 5 rather than negative 10. And the hedge cost is negative 10. The net share price now in the old world would be negative 45, and it'd be positive in the new world. Cash flow plus 55 because we get that in our pocket. In the new world plus 28, and a total wealth perspective, in the current we'd get 100, in the new we'd get 51. We can actually see in a sideways market, the hedge works against us, right? we'd be probably better off actually just getting the full premium, because the hedge is actually costing us 10, which was netted with the current 10 anyway. It's just bearing in mind that in a sideways, it may not be as beneficial. Let's say if coin rises now and the current is 50, the new would be 25, the premium 50% of that is 25. The coin slice has obviously gone up 10%, so that's 25 on both sides. The M2M has actually gone up in the current by 30, but in the new 25, because we've got the hedge costs. The net share is 105 and the new is plus 70. We can actually see the cash flow is plus 50 versus plus 25, and the total wealth is plus 15 plus 95. We can actually see that the best thing that this new strategy will give us is the drops. And because we've seen a lot of drops, this is why they're considering it. Now, the trade-off is there's a lot of variables that they could change here, right? They could change the hedge and how much they hedge. The IV is obviously moving around, and I've kept it simple. They could change the hedge ratio. The retention could change on how much they keep in the premium, and they could choose to issue more out as they adapt to the market. There's a lot of variables in here, but I just wanted to explain how the hedging in theory works. The variables that drive the outcome, the numbers above are, as I said, mid-range estimates. The actual dividend cut and NAV protection can swing wildly based on typically 4 key parameters. The strike selection, so how far out the money the short puts are. It's closer to out the money, 5%, you get fat premium. Mid out the money, 10% to 20% is balanced, and far out the money, 20%. The premiums are much less, but they are considerably safer. The other thing is the hedge ratio. What percentage of the short puts are hedged with long puts? Could be 0%, 25 to 50%, 75 to 100%. Every 25% more hedging reduces the dividend by, in this case, £8 to £12, but cuts the put loss down to 30 to 40%, which is massive. And I think this is the reason why they're struggling to get this out there, is because they're not sure what they're going to make each of these ratios. And they're probably looking at the data and data crunching to figure out what makes sense. They've obviously got the IV regime, which is the implied volatility, which is the premium. And again, this has a massive impact on the dividend by plus or minus 30% month to month. And the 10-month IV history ranges from 58% to 115%. Again, a really hard metric to lock down in a stock that's so volatile. And then the retention, right? What fraction of the premium stays in the NAV? Again, do they retain nothing? Do they retain 30 to 50%? Do they retain 7 to 100%? 50% retention halves the dividend, but adds around £15 to £30 per month to the NAV. And this will compound over time. There's no right formula here, but hopefully you can kind of see how this is a real challenge for them as fund managers when it comes to the hedging, to balance all of these different factors that you've got, which is the strike selection, the hedge, the IV, and the retention all need to be balanced out. We can actually see with this structure, in terms of the long-term holders, if you're in phase 3 of my house money formula, which is you've got the pure profit, you don't need big monthly dividends. You just want stable capital. You want hedging to preserve the principal because you've already recouped it all back. If you're in that phase 2 where you're close to break even, you've almost recouped the initial £1,000. You want the maximum cash flow to get there faster. Smaller dividends just leads to slower recovery. And then you've got the short-term phase 1 holders. If you bought recently and need the high yield to make the math work, the dividend cut directly hurts your expected return, but the NAV protection also limits your downside. Best scenario is for long-term holders, and I think that's why they're looking at it. They're looking at after the long-term holders because they want the fund to be around and they want it to be stable and want more people investing in it. And the only way you can do that is if you can prove that it's a good long-term hold. That was all I really wanted to cover. I just wanted to talk about the NAV decay. I'm just going to quickly summarize because there's a lot of other stuff in here, but I've already covered it. The bottom line is it's a cash flow engine still built for a specific timeline. You're accepting severe potential permanent capital erosion in exchange for accelerated cash recovery. Do not buy this fund if you expect your NAV to grow, certainly in the current environment of the way it's set up. You're buying this fund to survive long enough to reach phase 3, which is house money, after which every dividend is risk-free return on the capital that is already paid for itself. Sorry guys, I know this was another really long video, but I wanted to go in a bit more depth into some of the mechanics. And this probably won't interest everybody, but hopefully some of you found it useful and it gave you a bit more concepts and understanding of how these types of funds and options in general work. If you like the video, don't forget to hit that like button and let me know in the comments whether this was helpful. If you find it too much, then let me know and I'll just keep it really simple next time. Just let me know in the comments if you still want me to carry on doing these videos. Thanks a lot, guys. I will catch you on the next one.